Hi everyone, I'm Florbela Yates and I'm responsible for the investment distribution in MFP and chair the MFP Investment Committee. I will be your host for today. Firstly, I would like to thank you for joining today and for your support for our business. I hope you enjoy the webinar and find the information helpful. Before we start with the session, just a few housekeeping points. We applied for continuous professional development or CPD points. I know that this is important to you, so please watch the full session and add your ID to the CPD section so we can verify your attendance. Our event platform will remain open until the end of June for you to still view the event and receive the CPD points. You will receive a separate email from the Momentum Sales Academy with your CPD certificate during July 2023. Please feel free to ask any questions in the Q&A section and our speakers will answer them live or get back to you after the session. Okay, so let's kick off the session. I know it's a cliche, but wow, this year is flying. It feels like just the other day I stood here before you for our first MFP Outcome Matters webinar of 2023. Since then, former American President Donald Trump was arrested. A fun fact in case you didn't know, Trump isn't the first American president to be arrested. That title belongs to Ulysses S. Grant for speeding down a street in Washington with his horse and buggy. Quite different from what Trump's been arrested for. Anyway, I also, for the first time in my life, saw a coronation of a king and the appointment of a minister of electricity. Then there's AI, a topic in almost all media at the moment. The rapid advancement in artificial intelligence is exciting and the application of it in our environments will be interesting to watch. It's going to make our lives a lot easier in many respects. It certainly has me intrigued and I'd urge you to look it up. You can start with ChatGPT, which wrote my mom a lovely Mother's Day message. I joke, of course, I'd never do that. But ChatGPT has set the record for the fastest app to have 100 million users. It achieved that in only 2 months and now has 25 million users per day. Speaking about growth in usage, it brings me to our first speaker. Rupert Giesing, Business Development Manager for Equilibrium Investment Management, will update you on the MFP Houseview support. Over to you, Rupert.
Thank you, Hugo. A question I often get asked is why should I use the MFP Houseview range of solutions? An important consideration for Houseview advice houses like Momentum Financial Planning that follows a Houseview approach is that it is aligned and integrated with the advice process, and it is endorsed by the advice firm as appropriate for the client's investment objectives and risk tolerances. Also consider the following benefits of using a Houseview. Consistency. By using a Houseview range of portfolios, financial advisors can provide a consistent investment approach across all clients. Advice risk is significantly reduced as it can help to ensure that all clients are receiving similar advice and investment options that align with the advice house's investment philosophy and constantly evolving regulatory requirements. Efficiency. Researching and maintaining a wide range of investment portfolios across an advisor book can be time-consuming and resource-intensive. Using a Houseview range takes the guesswork out of selecting suitable portfolios for clients. Financial advisors can leverage the expertise and resources of a dedicated team of investment specialists, which can help to save time and improve efficiency. From a regulatory perspective, it also ensures that the necessary ongoing due diligence on investment managers are taken care of. Risk management. Financial advisors can manage risk by ensuring that all clients are invested in portfolios that align with their risk tolerance and time horizon. This is complemented by an outcomes-based investment philosophy, like we follow with our multi-asset class solutions, the MFP-focused model portfolios, and the Momentum-focused fund of funds. The parameters are clearly defined and can help to reduce the likelihood of clients taking on too much risk or not enough risk, which can negatively impact the investment experience. Flexibility. While a Houseview range of investment portfolios provide consistency, it also allows for some flexibility. By incorporating funds across different asset class spectrums, for example, cash and income, multi-asset class, and global funds, financial advisors can select a portfolio that best matches their client's specific investment objectives and risk tolerance. This can help to create a customized investment approach for each client while still adhering to the investment's Houseview philosophy. Client education. When combined with an outcomes-based investment philosophy, a Houseview range of portfolios can also be used as a tool to educate clients about different investment options and the associated risks and potential returns. Financial advisors can use the range to explain how different portfolios may be more appropriate for different types of investors and time horizons. For example, Focus 3, 5 and 7 that has different investment targets and minimum recommended investment terms. This can help to build trust and confidence in the advice process. Dedicated support. Clients are becoming more informed, and this puts considerable demands on financial advisors. Dedicated support by a team of Houseview investment specialists and relevant related content, like we have with the MFP Houseview, enables a better understanding of why and when markets and investment values rise and fall. The financial advisor's expert advisory skills and good client relationships are complemented by in-depth investment and market knowledge supplied through Houseview support, which also assists in keeping clients invested when times are tough. The next time you wonder if you should consider using the MFP Houseview funds, remember these important points. Speaking of, from a support perspective, it is very encouraging to see continued increase in support of all of our MFP Houseview solutions. Looking at our MFP focused model portfolios that celebrated their second birthday in March, we continue to see a steady increase in support of these solutions. Support grew by 14% from the beginning of the financial year, and we now have 200 advisors making use of these solutions. Support for the Momentum Fund of Funds range also remains consistent, with 586 advisors using the funds in their advice process. Amidst the volatility and uncertainty of financial markets and rising interest rates, we've seen a significant increase in the support of our cash and income solutions, which includes the Momentum Money Market, Enhanced Yield and Flexible Income Funds. Support grew by 22% since the beginning of the financial year, with 741 advisors using the funds. In our global solutions, support has remained fairly consistent, with 248 and 107 supporters using the feeder funds and direct offshore solutions respectively. Looking at assets under management, Houseview investments grew by 17% overall, aided by a combination of flows and market growth. Just another testament to the success of having our own in-house and bespoke model portfolios that assists our advisors to help their clients to reach their financial goals. From a flows perspective, and tying in with the increase in support in our cash and income solutions, we've seen strong inflows into these funds for every quarter of the financial year so far, with inflows in the region of 1 billion rand per quarter. It is encouraging to see that we are also seeing consistent inflows into the MFP focused model portfolios of between 150 and 200 million rand per quarter. I would like to urge you to consider the potential long-term impact of keeping clients invested in cash solutions due to the uncertainty of short-term returns of our multi-asset solutions. Yes, the focus solutions, both models and fund of funds, can be impacted by volatility over the short term, but they are positioned to capitalize on the return potential of all asset classes over a minimum period of their respective time horizons. By realizing the importance of staying invested over the minimum recommended time horizon of these solutions, in spite of short-term market volatility, you are making a significant contribution to your clients achieving their investment goals. I want to thank every MFP advisor that makes use of these solutions for your support, and I look forward to a long and fruitful relationship with you. I would like to leave you with this quote by Benjamin Graham. Successful investing is about managing risk, not avoiding it. Hope you enjoy the rest of the webinar. Thank you.
Thank you, Rupert. I would like to, on behalf of all of us at Momentum Investments, thank you for your continued support on the platform and Houseview solutions. It's encouraging to see the number of supporters grow, as well as the flows into the solutions. Next up is Sanisha Packirisamy, Momentum Investments economist. Sanisha will discuss the known unknowns plaguing the outlook for the global economy. Sanisha, welcome to the stage, and I certainly look forward to, as always, your valuable insights.
Thank you and welcome. The future is fundamentally uncertain, But today, there are an unusually large number of unknowns facing the global economy. Former United States Secretary of Defense Donald Rumsfeld famously remarked that there are known unknowns, things that we know we don't know. In this age of permacrisis, there is a long list of known unknowns. We know that the world economy is likely to suffer some economic damage following a sharp tightening in monetary conditions, but we cannot yet quantify the final damage in economic growth terms. We know that jobs are likely to be lost, but we do not know where levels of unemployment will settle. We know that geopolitical fragmentation remains a key threat to global economic growth, but we are uncertain as to the outcome for international relations. The World Economic Forum, or WEF, notes that the health and economic after-effects of the COVID-19 pandemic quickly spiraled into a compounding crisis. The WEF also highlighted how food and energy became weaponized by Russia's invasion of Ukraine, which sent inflation soaring to decades-high levels. The cost of living crisis that then ensued reached all corners of the globe and ultimately fueled social upheaval in a number of states in both the developed and the emerging world, as inequality within and between countries continued to rise. As we enter an era of less accommodative monetary and fiscal policies, governments, individuals and businesses will likely face more challenging conditions in acquiring and maintaining debt. Although we are through the worst of the pandemic and likely also the Russian invasion of Ukraine, economies will not rebound quickly from these calamities. The International Monetary Fund, or the IMF, warns that the output gap, which is just the difference between actual and potential growth, is expected to widen to a cumulative output loss of 2.7% of GDP by 2026. This indicates that world growth is definitively worse off, given the effects of the pandemic and the war in Ukraine. Similarly, the Organization for Economic Cooperation and Development shows that potential output growth has slowed significantly since that 15-year period leading up to 2010 for both key advanced and emerging economies. Activity in the world economy snapped back reasonably quickly following the global recession in 2020. This latest recession was, of course, triggered by stringent lockdown regulations across the globe to help slow the spread of COVID-19. Governments and officials embarked on massive fiscal and economic policy interventions to help restore economic, social, and health outcomes. But only now is the world coming to grips with the unintended consequences of these actions and the externalities that have extended to poorer nations. The first of these known unknowns that we are dealing with is how the global economy will respond to the abrupt shift from ultra-accommodative policy to a more aggressive tightening stance. The world's largest central banks, being the United States Federal Reserve and the European Central Bank, flooded markets with liquidity via their bond purchasing programs. Firstly, after the global financial crisis, but again in the aftermath of the pandemic. Inflation has nevertheless caught up, and in the recent year, central banks have had to battle the highest inflation rates in decades. This forced interest rates significantly higher over a very short space of time. Market liquidity is being drained even further by central banks, either selling securities outright or choosing not to roll over bond holdings that have already matured. Moreover, core or underlying rates of inflation remain sticky, despite the drop we've seen in food and fuel inflation. Initial rounds of high food and fuel prices have spilled over into other areas of the basket, notably wages and services. With the IMF noting that inflation is unlikely to return to target for many economies before 2025, central bank rhetoric has remained hawkish. Given the sharpest pace of monetary policy tightening in almost 4 decades, home prices have also crashed in response to higher mortgage rates across a large number of key economies, including New Zealand, Sweden, Australia, and even Canada. With central banks telling us that they are unlikely to reduce interest rates at least until they see clear signs of inflation on an obvious downward trend towards their respective targets, a tight monetary policy stance could exacerbate growth woes in the global economy and raise the risks of a harder landing. This is particularly true given the effects of tighter monetary policy on the financial sector. The IMF notes that the fall in the gilt market in the United Kingdom last year and banking turbulence triggered by a few regional banks in the United States more recently highlight the vulnerabilities in certain segments of the financial services sector, most notably in areas where credit system has been intermediated by unregulated non-bank entities. Now, even though commercial banks are far better capitalized today than where they were in the run-up to the 2008 global financial crisis, problems in this part of the financial sector can have negative spillover effects elsewhere, particularly for entities with excess leverage, credit risk, or even interest rate exposure. The IMF warns that this could extend at a country level, with tighter global financial conditions potentially creating a risk-off event, triggering capital outflows from perceived riskier jurisdictions. This would ultimately have a negative effect on risk premia, confidence levels, and even spending and investment in these countries. The combination of higher interest rates and significantly slower growth comes at a time when the world is mounting the incline of the debt roller coaster. The Bank for International Settlements, or the BIS, warns that mounting debt is yet another challenge facing central bankers as they try to rein in hot inflation. Very high debt levels, both in the private and public sector, heralds more sensitivity in the global economy to a further rise in interest rates. The IMF notes that world debt has reached a whopping 250% of GDP. This is nearly 20% higher than where we were in 2008. But it is more than just on-balance sheet debt that poses a risk to the outlook for global economic growth. The BIS has flagged the risk of hidden off-balance sheet debt. The BIS claims that pension funds and other non-bank financial firms have more than $80 trillion worth in debt in foreign exchange swaps. The BIS notes that this could be a blind spot for policymakers, and they warn of the risk of potential funding squeezes. The share of countries facing a high risk of debt distress is elevated by historical standards, and this gives rise to potential fiscal shocks, particularly so if structural reform efforts on the part of fiscal and macro authorities are seen to be lagging. Despite a lower level of external debt relative to gross national income than what we experienced in, say, the 80s or 90s, a higher share of debt today is issued at variable interest rates and in US dollars, both of which increases external risks. The IMF calculates that more than half of low-income developing economies are already in debt distress or at a high risk of reaching this level of vulnerability. Similarly, a quarter of emerging market economies are being viewed at high risk of debt distress. Now, over in developed markets, a looming budget fight could result in a fiscal showdown in the United States. Now, the debt limit sets a legal maximum on the nation's outstanding debt. And once that limit has been reached, government can only spend what it receives in revenue. As such, running a government deficit means that government may not be able to pay all of its bills on time, and this could potentially lead to a government default. Now, while the drama of the debt limit has intensified every time the new limit has been breached, it has often resulted in a last-minute resolution. Nonetheless, investors cannot overlook this as a potential risk to destabilizing financial markets, particularly as we approach the middle of the year. Although China's economy is set to rebound this year after activity recovers from authorities lifting strict lockdown rules, China's debt mountain, largely driven by credit fed to state-owned entities, poses a risk to longer-term growth. Moreover, the contraction in China's real estate market is a major headwind to growth dynamics, even in the short term. A shrinking population and slowing productivity growth also argue for lower trend growth rates out of China in the longer term. Now, by raising household spending and services as contributors to overall growth, an inward focus of Chinese policies suggests positive growth spillover effects for the globe will be lesser than before. There are a number of red-hot geopolitical flashpoints in the globe that threaten to unravel global economic prospects and could even sour international relations, leading to an erosion of the existing systems of global cooperation and governance. These include a security crisis over Taiwan, led by China, escalating tensions between China and the United States, the rise in economic nationalism, a prolonged conflict in Ukraine, American relations in the Gulf, and renewed confrontations between Iran and the West. With regards to the first geopolitical flashpoint, China's potential invasion of Taiwan has already undermined trade relations and has caused a dip in business confidence amongst China's trading partners. Speculation is rife around a potential acceleration in the shift in global supply chain orientation, which could have a significant bearing on the structure of the world economy and even trade relationships. Escalating trade tensions between the world's largest two economies, being the United States and China, could also significantly disrupt international trade and relations. The trade war is now extended to technology and even possibly currency wars, fueling stagnation in globalization trends. Now, in the past, we've seen how a coordinated response of major economic superpowers can prevent an even larger catastrophe during times of crises. However, the Peterson Institute for International Economics shows that a rise in nationalist economic policies across the globe could result in authorities resolving for short-term domestic pressures, making it much harder for governments to focus on the longer-term priorities. This could result in limited political capital being allocated to broader global concerns. And in turn, this could exacerbate trends in political polarization and accelerate an erosion in social cohesion and geopolitical frictions, leading to further inequality within and between countries. Increasingly, policy platforms of the largest political parties within the G20 countries are stressing national sovereignty and rejecting multilateralism. History has shown that when countries adopt individual responses rather than using a coordinated approach, these actions can aggravate a global slowdown. This is particularly true when protectionist policies are adopted and currency devaluation practices are then taken on board. The geopolitical landscape has also become very closely intertwined with the rise in coordinated cyber attacks. Hybrid warfare appears to be the new reality, as seen with Russia's invasion of Ukraine and cyber attacks against critical national infrastructure. We are possibly entering an era in which state actors utilize cyber attacks to disarm global economies. This trend poses a risk to numerous industries, spanning from the energy industry to financial services. The WEF warns that cybersecurity risks create yet another wedge for divergence rather than cooperation among countries, especially where already heightened tensions exist. Finally, geoeconomic fragmentation poses a risk to forming a collective response to global challenges, such as tackling climate change. The long-run effects of not mitigating climate change effectively will result in significant economic damage to the global stock of labor and capital. Moreover, inflation will likely rise as production in global crop yields decline. In addition, higher insurance premiums will raise business costs that will ultimately be passed on to consumers. Climate change is worsening livelihoods in regions that are more vulnerable to changing weather patterns. It is becoming an increasing driver of displacement and migration, competition over limited land and water resources, and even food insecurity. The United Nations reported that 9.8% of the world's population were affected by hunger in 2021. This compares to a lesser 8% in 2019. Now, these 10 known unknowns, which span a multitude of dimensions, including political, societal, regulatory, and economic facets, suggest that market volatility will remain high in markets. Indeed, these areas of vulnerability should raise concern over the prospect of a more meaningful slowdown in global economic activity, but it could also give us clues of how market returns are likely to shape up. While some of these known unknowns could turn out to be less damaging than initially anticipated, we need to remain aware of possibly even some of these risks derailing the world economy's shaky recovery. Moreover, what about the unknown unknowns, as Rumsfeld referred to? The risks we don't know. These perils lurking in the background further complicate economic policy making. As such, it remains imperative for global authorities to adopt a globally integrated, risk-based approach to policy making in order to detect and address economic vulnerabilities early on. Strengthening international cooperation, rebuilding multilateral governance, and pushing past short-term national responses are all necessary tactics for the global economy to navigate this complex risk backdrop. Only then can we balance macro resilience with inclusive growth outcomes. Thank you for your time.
Thank you, Sanisha. We certainly hope that these known unknowns do not disrupt the global recovery. Next is a panel discussion moderated by the Head of Equilibrium Investment Management, Florbela Yates. The panel will discuss how they have been navigating the investment environment with the MFP Houseview funds.
Thank you, Hugo. It's been a tough time for investors over the past few years. South African investors are really battling, and they have less disposable income. We're living in a world with high inflation, high fuel costs, high food costs, and obviously this translates into less disposable income. As advisors, it's becoming increasingly difficult to get clients to part with their hard-earned cash. And their cost of living has risen. The LISPA stats are showing that flows across the market are under pressure, and the increased levels of load shedding haven't helped us at all. We keep hearing how investors are withdrawing money to fund increased costs of living, and especially for solar, inverters, and rising diesel costs for their generators. So as advisors, it's becoming harder to get clients to part with their hard-earned money, and even tougher to convince them to stay invested. In today's panel, I'd like to explore the effect of markets and asset classes and the effects that this has on advisors, and use that information to enhance your advice conversations and help investors understand the effect their decisions have on their wealth. As an organization, our portfolio construction process begins with strategic asset allocation. And research has shown that sticking to the strategic asset allocation is the most important determinant of getting to a particular outcome. But we obviously manage the portfolios actively. And so we spend a lot of time with each of the underlying investment managers trying to identify opportunities in markets and then making tactical changes in the portfolio to take advantage of these short-term opportunities. But these tactical calls are always at the margin within acceptable bands. We never want to erode all the value of the strategic asset allocation work by taking very big tactical asset allocation bets. So Ian, I'm going to start with you. It always amazes me when I look at the flows to see that switches from multi-asset class portfolios into fixed income portfolios, cash income, bond portfolios, always seem to happen a month or two after markets have done badly. And the opposite is true, when markets do well, a couple of months later, you see them switching out of your type of portfolios into asset class portfolios. From your perspective, you look across the whole fixed income spectrum. So for investors who are looking into entering the market or make new investments, which asset classes do you think are the most attractive at the moment? And where do you expect investors to get the best returns over the next 1 or 2 years if they're entering the market for the first time now?
Interesting time, Fluff, in market as always, but it's true what you say. You can never time markets perfectly, although there's interest rate cycles. But even for us as a team, I mean, it's what we do every day is try and get to that perfect timing. But obviously, it's very hard. But we think there are good opportunities, and I know it's hard when we listen and we read, and there's such a lot of negativity around. But look, as I've said before on your panel, that cash is definitely not trash at the moment. I think we're seeing the best cash real yields that we've probably seen in more than 20 years in South Africa, that if you get 3% real in cash, so inflation 6 this year, money market yields are above 9% at the moment. I mean, it's a very good hiding place. In the interim, if you wait and you say, well, look, I'm concerned there may or may not be a recession in the globe. There's a lot of uncertainty in South Africa. So cash is definitely a good hiding place. I've been negative credit for quite a while, really because of price. But the one thing I have to admit is that we've seen a whole host of results come out this year so far. And corporate South Africa is actually in a very, very good position. The balance sheets look as good as they've ever been. So from a risk perspective, credit looks like a very good hiding place to hedge yourself from, let's call it, government South Africa. So we like the corporate space, especially the private corporate space. We think there's great opportunities there. And then lastly, it's obviously in duration assets, but then you've got to take a longer term view. So, bonds and inflation bonds still look very attractive. But yes, they're probably not going to play out this year. They're probably going to play out over the next 2 years or more. We probably have to get the SARB into the rate cutting cycle before it will probably play out. We're probably still in a rate hiking cycle. But yeah, basically all the fixed income yield curves in South Africa look very attractive, and there's high real yield returns to be had over the next 2-3 years probably in most fixed income asset classes at this point in time. Okay, so I'm going to ask you the same question, but now from the perspective of clients that are already invested in your portfolios. Given where inflation is at the moment and rates, where do you think the risks lie, and what should investors be doing in the short and medium term? What sort of performance do you think they should expect, and why should they remain invested in fixed income? Well, if you're in, so if you have a 10-year bond yield that's well over 11% with inflation at 6%, it's probably just ride it out. If you have inflation bonds sit there, having 5% real yields in your portfolio for the long term, that's a great space. I mean, we're talking about equity-like returns from fixed income. Yes, there's obviously risks. If you've got new cash to apply to your portfolio, well then go to the cash market. I think there's good opportunities in cash to sit and wait. If you're willing to take more credit risk, well then you can go to the credit markets. As I said, I think all 7 yield curves in South Africa at the moment look very attractive. It depends on how much risk you want to take. If you're in, don't sell, because crystallizing losses at the moment, because that's what you'll do. If you panic now, you'll panic at the top of yield, so at the lowest prices. We think that's not a prudent strategy. We're probably getting to the end of the rate hiking cycle. And once you get this momentum and the market starts pricing that the SARB will probably not hike rates further, you'll probably see that reflection in yields as well. So don't crystallize the losses, don't panic here. This is a time just to be calm and take your extra cash and put it into higher cash yield. Don't leave it in your bank account, because earning 3 or 4% in a bank account doesn't make sense when your money markets and enhanced yield type funds are yielding you close to 9%. That just doesn't make sense to sit in a cash bank account. And I think it's also quite important to understand that with this new deposit insurance scheme that's going to come into the banking system, it's very dangerous to go and sit with R1 million, for example, in your call account or your current account, because if that bank should hit the skids, and please, I'm not saying banks will hit the skids, but they will only pay you out 100,000 Rand. So be very clear that when you sit on a lot of cash in a bank because you're worried or you're concerned, rather put it in a money market fund or enhanced yield fund, that you diversify that risk away. So that would be the smart, prudent view at this point in time.
Thanks, Ian. That's excellent points there. So for an advisor, whether you're phasing in money or using a bucket approach in your advice process, for your shorter term money bucket, 18 months to 24 months, putting it into an income solution, it's important to explain to clients that they should leave the money in that portfolio and then allocate the rest of their money to more aggressive asset classes where they can get higher growth, but obviously with a little bit more volatility or risk. Okay, Ronnie, on to you now. As one of the portfolio managers for the focus range of portfolios, can you maybe explain to us how you get to your strategic asset allocation views and then also how you make tactical calls around those?
Yeah, certainly, Flof. I mean, so when we construct a portfolio and we set up the strategic asset allocation for that fund, we first of all go through a very extensive modeling process. And what we do there is we look at the historic asset class returns dating back approximately 50 years, or let's say to 1970. And what we're looking for is those relationships between the asset classes and how they correlate to each other over time and through various market cycles. Once we have the information, we then apply that knowledge to our forward-looking long-term expected returns for these asset classes. And then once we have all this knowledge, we would then look at all the combinations of asset classes that would ultimately deliver on the risk and return objectives of the fund or the portfolio we're trying to construct. So maybe to make it real for you, if we look at a Focus 7 fund, for example, we look at all the combinations of assets that are going to most consistently deliver on that CPI plus 5 objective over any rolling 7-year period, while simultaneously not exceeding a 10% capital drawdown over any rolling 12-month period.
Okay, that makes sense.
Right. So in addition to that, we have to consider as well what are the current or prevailing Regulation 28 constraints that may apply to the fund. We would look at, for example, your CISCA constraints, and in the case of a fund-of-fund, also the relevant ASISA category that the fund would fall into. That's right. So from there, obviously the SA is very important to us because it really anchors us from a risk perspective, but it really isn't a set and forget approach. So we have to stay nimble and we have to adapt to the prevailing market and economic conditions. And that's really where your tactical calls come in. So when we're talking about tactical, here we're really looking at the short term up to, let's call it 12 months out view on markets and asset classes. So we would take the strategic asset allocation as a starting point, and we would then tilt the individual asset classes around that, typically by approximately 5% per asset class. And the reason for that is twofold. So first of all, we don't want to time the markets. And secondly, let's say we have a very negative view on markets. We wouldn't want to de-risk a Focus 7, for example, to the point where it starts looking like a Focus 5, and a Focus 5 to the point where it starts looking like a Focus 3, and vice versa. And also at the same time, should the markets turn around, we wouldn't want to miss out on the opportunity to participate in that recovery. Now, our tactical views are really informed by all the information we have available, both from an economic and market perspective, the views from our broader investment team, the views from our internal and external economists, our investment strategists, but also through our engagements with the general fund manager community at large, both locally and globally. And then maybe just lastly, to touch on how frequently we would make those tactical calls, I think there's no real set limit. Ultimately, it really depends on how strong is our conviction on a particular view, and ultimately how quickly the market conditions around us are changing.
Okay, that's great. So as you can see, it's very scientific, and it talks to why you need to be considering time in the market rather than trying to time the market, as you so aptly said. It also explains why it's so important for investors to stay invested. Investors who switch in and out of portfolios based on what happened in the market last month or the month before are always doing so after the fact. And that explains why invariably they don't experience the same performance levels that we see of investors who actually have stayed invested in the portfolios through time. So Dean, as the other portfolio manager for the focus range of models and fund of funds, what are your current views on the various asset classes?
Thanks, Flof. So I think it's been it's a relatively tough time in markets, particularly as a South African investor, when you have a very compelling valuation case across South African asset classes, relative to global asset classes. But you also understand the idiosyncratic risks that are present in South Africa. And Ian touched on a few of them already when he spoke to the fixed income asset classes. So maybe to start on the local side, I think the valuation case is very compelling, and I'm not going to reiterate what Ian has said. Obviously, South African bonds are very attractive and offering equity-like real yields with probably the most narrow outcome looking sort of a year out from now. So we are quite bullish on SA bonds at the moment. Coming to SA property, we think SA property fundamentals have bottomed out and are probably turning, but it's nothing that we're getting really excited about. I mean, if we look at it, load shedding is going to constrain their earnings to quite a large extent. And if we look within the sectors, something like office is still experiencing significantly high vacancies. Rental reversions are still coming through quite negative. And so there's probably still a bit more pain in that space, but it's good to know that the fundamentals are turning around. And on the other side of that, you have valuations that are accounting for the negative fundamentals. So we're not too negative on property, but it's probably the asset class in South Africa that we're least excited about. I think similar to local bonds, local equities are very attractive, again, from a valuation perspective. And if we look relative to history as well as relative to emerging market peers, for example, our equity market is extremely cheap. But I think this is going to be an environment where one needs to be a bit more cautious, and I think that's where we get a bit more comfort by employing both a sort of systematic as well as active managers to navigate this environment. Because yes, while there are some very compelling companies in South Africa, there are certainly going to be some that may end up being value traps, at which case there's potential for permanent capital loss, and that's something we don't experience. So attractive South African valuations, we'd still want to be in a bit of a sort of overweight position, but we are somewhat concerned about a potential recession on the horizon, and so we don't want to be fully overweight in equities just given the short-term recessionary risks, especially given that we should see sell-offs. If there is one in the global space, that should also hit home. So then moving to the global space, I think it's fair to say that we still favor local over global, but within the global space, I think there's become a lot more alternatives to invest in at this point in time. So for a long period of time, you really only had equities to invest in from a valuation and from a macro perspective. Now we have short-term cash yields in the global space above 5%. Bond real yields have returned to the global bond markets, and so it makes a much more compelling argument and offers a lot more diversification in an overall portfolio. So I think we'd be a bit neutral on the likes of global cash and global bonds, just given the yields that are on offer, coupled with obviously the recessionary risks on the horizon. They will act quite defensive. I think in the case of global equity, we are still a bit concerned. We think global equity valuations, although they have come off quite extensively, we have seen quite a sharp rally over the last 6 months. And even at these levels, we think equities are probably pricing in too much optimism. There's too many stars that need to align to justify current equity valuations. I mean, you've got the recession on the horizon, you would need a soft landing, you'd need earnings to not be too impacted, and you'd need to see a sustained move down in inflation to warrant a turnaround in US Fed monetary policy, and all of those things to align at the same time to justify current valuations. We just think you need to be a bit more cautious and hence be probably slightly underweight on global equity. And then perhaps finally on global property, like local property, fundamentals are somewhat under pressure, particularly in the US office space. Like local office space, vacancies are ticking up. And after we've seen this mini banking crisis, it's going to be a lot harder for global property companies to refinance. Firstly, just to get access to financing, given potentially more stringent regulations. And secondly, refinancing it now at 5% as opposed to the 0% that they were financing. So maybe to sum it up, certainly a local versus a global story given the valuations, but you don't want to be too underweight globals just given that they are offering a lot of diversification. And of course, seeing these short-term sentiment rallies, if you're too underweight, you can get a point where you get wiped out from a return perspective without having enough global to compensate you for a risk-off scenario.
Okay, thank you. Sure, so much to think about. I think we're really blessed to have 3 of our brilliant portfolio managers out here and to see how deep their thinking is and what they deal with every day. So thank you for sharing that. I guess since you touched on global, maybe ask all 3 of you. You can decide who goes first. Last year we saw a lot of changes to Regulation 28 that now allow us to take up to 45% of our assets outside of South Africa. How does this affect how you allocate in local portfolios to offshore components and where you actually put the money? I heard your views on asset classes, but has it been an opportunity to take a larger amount offshore? Is it the same across all portfolios, or would it be different for conservative and more aggressive portfolios? I don't know who would like to go first.
I'll have a stab at it. So, look, I think the first starting point once we had the changes to Reg 28, and maybe coming back to Ronnie's earlier comments, is setting up a new strategic asset allocation that will give you the highest probability on delivering on the objectives of the portfolio over the long term. So that was the first starting point to say, now that we have new regulatory environment, what is the optimal asset class weightings that you want over the long term? And then it's about assessing existing market conditions and how do you get to those strategic asset allocations. And I think for the most part we saw, roughly 5 to 10% increases in total global allocation, depending on which portfolio you're looking at. And we have opportunistically used, movements in markets to get a lot closer to that. The one that we've struggled with mostly is global equities, for obviously the reasons, as I mentioned earlier, our concerns around the asset class itself. But for the most part, the likes of global property, global cash, and global bonds, where we've seen opportunity, we've used the appropriate time to increase that offshore allocation. But it has been exceptionally tough considering what's happened to the rand over the last sort of 6 to 12 months. We sat here probably 3 months ago, we would have said 1750 is an extreme, and now we sit here today and the rand is closer to 19. So I suppose it comes back to having discipline in that strategic allocation, because it gives you an anchor point to protect you from these adverse conditions or things happening against what you expect. So yeah, we've taken a bit of allocation offshore in the likes of cash, property, and global bonds, but still struggling to get to that total or in line with our strategic view on global equity, just given valuations and of course where the rand sits today.
I don't know if you want to add anything.
Yeah, if I can just add to that, obviously the fund of funds and the model portfolios share the same strategic asset allocation. So as Dean mentioned, we went through a process of remodeling the strategic asset allocation subject to the Reg 28 changes, and that has definitely indicated that we want a higher exposure to global assets over the long term. Now that level is currently sitting between 30 and 40%, depending on how aggressive the fund is. And interestingly enough, even though the regulation allows up to 45%, our research has actually shown that once you persistently exceed that 40% limit, there are actually diminishing levels of benefits from a risk-return perspective. So from our perspective, we're happy with the 40% cap on our most aggressive portfolios, but it does not mean that you may not opportunistically want to exploit that 45% limit at certain times. So similar to the model portfolios, from a fund-of-fund perspective, if I think back to where we were in February 22 when the announcements were first made, the funds are currently holding approximately 4 to 7% more global exposure. But for all the same reasons, we are still not at our full maximum exposure. So currently, I think most of the funds are probably about 5% below that ultimate cap. And for the same reasons that Dean mentioned, I think it's been difficult to get there. Yeah. The rand has continuously depreciated since last year. If I think back to Feb 2022, we were probably sitting at the mid-15 rand to the dollar level, and currently we are at 18. So it has been difficult, but we have gradually, you're never going to time this thing exactly right. So we've been gradually increasing that exposure, taking opportunities in the market as we saw rallies on the local side, perhaps some sell-offs on the global side, and obviously as the currency has been very volatile, when we saw opportunities there, we would externalize some assets. We've also moved more into the fixed income space in the global side, a little bit more on the global defensives, so bonds and cash essentially. And where we've added a little bit to equity, we've also tilted the portfolios a little bit more to the emerging market side of things, since we think there's a little bit more support there for the market, especially now with China reopening.
Okay. Makes sense, and I think it's great to know that you follow a process and that you don't just go over overweight offshore, for example, because you're now allowed to do it, but that there's a real thought process, scientific. It gives me a great sense of comfort. And especially knowing that we've got a team of people looking at it locally and internationally, and that we're not relying just on currency traders to tell us where the rand's going to go, because not even they get it right. Ian, from a fixed income perspective, do you think the same way as the other two, or are there other considerations? Because obviously you're getting quite high yields in local fixed income assets.
No, true, but remember we are valuation based, so going offshore for us is still about valuation opportunities. So not in global yields. I think it's for us much more specific around US yields, where we could enter, especially the front end of the curve. We're obviously much more specific in where we want to tactically be. But the real game changer for us for offshore was actually offshore credit. Remember, offshore credit spreads were very low for more than a decade, and then obviously with this secondary banking crisis in the US and in Europe, we've seen credit default spreads in dollars and euros move dramatically higher because the market just sells off. So we are finding good opportunities in dollar bonds. I'm talking credit bonds, corporate bonds in the US and in Europe. So you're talking about companies that's on a global scale rating, probably rated above the South African government rating, at spreads similar or higher than corporate or bank rating. So you're buying something that's better quality with more spread. Now that's sometimes the holy grail for valuation type investors. You're buying quality at a cheaper price. And we're finding those opportunities, but they're not abound. You've got to go and hunt for them in our world. It's that typical thing that we've got to go through 10 tons of rocks before we find the one diamond, and there's lots of rocks out there. So let's be clear, it's not just throw a dart at a dartboard and finding opportunities, because there's lots of risks in those US credit markets because they're coming out of this obviously ultra low decade of interest rates. So there's lots of stress on the balance sheets, but where you find corporates that's done the right actions, have got a war chest on the balance sheet, and the spreads are just elevated because the market sells off. We think those are great opportunities in dollars. But in our portfolios, we don't take the currency risk. We swap it back to rand, and I can promise you the Java yields, as we call them, they just look very attractive to us at this point in time. But it is a selective opportunity. It's not across the portfolio.
Okay, thank you. I think this is probably a good time to move on to the global discussion. We've spoken a lot about global inflation. I think you can't open up a newspaper or attend an investment presentation without some discussion on inflation. Nats, for you maybe, can you share with us how the Momentum Global Investment Management team, the MGIM team sitting in the UK, thinks about the opportunities and the risks facing investors at the moment, and specifically over sort of the short to medium term, and whether it would be the same for all offshore markets or whether it looks different across different geographies?
Well, Fluff, I think when it comes to global markets, there's never a dull moment. I think to quote Ian just now, it's interesting times. And I think that's why it's so important as investment team members. You guys do it in your local portfolios, Ian on your fixed income side, and of course our offshore team does the same in the global funds, to always employ broad-based diversification, because it's the best way to ensure that you not only, I suppose, have a better chance of achieving those return targets you're trying to achieve for your clients, but also, where possible, provide protection against those risks and surprises that inevitably come our way. And we've seen many, many of those more recently. Just to think of some of the risks that we're starting to see, I think one that's starting to come up more in conversation is regarding the federal debt ceiling in the US. I think that failure to increase that debt ceiling has major consequences, not only for the US economy, but also the global economy. And it'll be unprecedented if the US decides to default. So that is an area of concern, I think, for a lot of investors. I think to counter that, of course, is the fact that we are of the view that it's unlikely that that debt ceiling will be breached. It's continually over time been risen because I think the risks are just too great the economy, global economy, if that did happen. But whilst we enter this period of uncertainty, the reality is there's going to be a lot of volatility, and I think that's going to be a bit of an overriding concern on markets. Another area, and you guys both alluded to it earlier, is the banking sector. So I know Ian talked more on the local side and you alluded to on the offshore side, but there's been a lot of concerns regarding the banking sector globally. And so I wanted to, I suppose, bring that up because that's where we first started to see the cracks as a result of tightening liquidity in the market, rising rates, and we saw the impact of those on regional banks really in the US with the failure of Silicon Valley Bank first, Signature Bank, and then the first, I keep on saying First National Bank, but First Republic Bank, that is the one, so not the South African bank. But obviously when all the pressure on those banks, you started to see depositors fleeing, so there's a run on deposits, and that's where you've started to see banking failures. And I think I wanted to bring that up because there's been a lot of concern regarding that, especially in the conversations I've been having with advisors on the ground and clients. But we do not believe that it's a systematic banking risk at all. And I think that's important from a risk perspective. Yes, there's going to be casualties. Yes, there's likely additional smaller banks that are going to come under pressure. But we don't think this is a broad-based banking crisis. And I think that's also very important. Repercussions of this, you mentioned earlier about the deposit insurance. So maybe there's going to be greater regulations on smaller banks. Maybe there's going to be greater or increases in the deposits that will be paid out. Maybe there's going to be tighter liquidity or tighter credit extension. And of course, there could be implications on commercial property and the loans thereof as refinancing comes through, as you alluded to. So there's going to be a lot of implications in that space. And so clearly there's a lot of things going on globally. And as a result of that, financial conditions there's a lot of fragility there. And so I think for central banks, to allude to your point on inflation, central banks really are in a difficult position because there's a trade-off between, I suppose, maintaining inflation, trying to keep it down because, of course, the inflation levels are still elevated, but also not to rock the financial system too strongly because that can really be negative, especially from a recessionary perspective. So in terms of what's happening, we've just seen the latest inflation print come out in the US. It came lower than expected, so that's a relief. So clearly, I suppose inflation, at least in the US, is starting to come down. In terms of the large drivers behind inflation, such as supply chain easing, energy costs, and then the better thing there, I suppose, in terms of the sticky element of core inflation, is services costs are starting to come down a little bit. But at the end of the day, it's still elevated. So, are interest rates going to be risen in the June meeting for the Federal Reserve? Likely not. I mean, the probability now, I think, is exceptionally low. So that's a positive, of course. But the same does not fall true to the UK and Europe, where inflation is still very sticky, where inflation still is a big problem, and interest rates are likely still going to rise because of the conditions in those particular regions. So I suppose just in a nutshell, there's a hell of a lot of things going on globally. Diversification within portfolios is going to be so critical because, as I mentioned earlier, there's so many surprises that are continually coming our way.
Okay, so based on all those reasons, how are you currently positioned in your portfolios? Is it all developed markets? Is there some emerging markets? What are your current positions?
Thanks, Flor. So I think our investment view in terms of asset allocation currently closely aligns with, I suppose, what Dean was saying earlier. And so let's start in terms of big picture asset allocation. So from an equity perspective, rightly as you said, given the stark decline in valuations last year, we saw massive sell-offs, so pretty much across every asset class, not just equities, of course. But you saw it most prevalently in that asset class. But since October last year, we've had a major rally. And that's why, although valuations are generally cheaper than they've been for a long period of time in equities, I think you must just temper the expectations regarding that asset class returns going forward, at least for now, just because of that earnings side. Yes, earnings have had surprises on the upside, which is great, but the reality is that monetary policy and the impact of monetary policy on company earnings has a bit of a lagging effect. So, and rising inflation. So, are earnings still going to come under pressure? It could likely come through. And if recession does come through as is likely expected, then that too could have an impact on earnings. So just temper expectations regarding the short-term outlook in terms of equities. Of course, it's such an important core allocation within a global portfolio, but we remain underweight for now and rather looking to overweight towards that asset class at a better entry point. But within the global equity market, we think there's amazing opportunities. So not only do you look at things from a stylistic perspective, so you want to blend growth managers, quality managers, and value managers, and also just there's a lot of opportunities in the small to mid-cap space even. But areas that are showing value in our view is places like the UK, places like Japan, which, you know, despite great valuations, have still struggled along. So we remain overweight to those regions, and we also remain overweight to emerging markets relative to developed markets, just because we think they've been really coming under pressure. And if the dollar weakens further, it is likely to happen. You know, the emerging markets should likely do well. In terms of fixed income, also, I mean, there's no longer that term TINA. There is no alternative. You know, everyone was always about equities for so long in the global space, but luckily, you know, diversification benefits are really going to come to the fore, just because global fixed income is showing valuations or attractive valuations again. And that's again because last year was a horrid year for fixed income in particular globally, not locally. And so where we're looking for value or taking advantage of now, it's also credit, more on the shorter end of the curve, shorter term credits, emerging and developed markets. We also like global bonds in certain areas because they're looking more attractive than they have in the past. There's also other esoteric areas that we're looking to take advantage of, potentially down the line, COCOs, interesting term that's been thrown around. We're looking to, in particular, stocks potentially take advantage of. So there's definitely opportunities. There always is. And that's where investment team members are so critical in terms of making those asset allocations as they come through. And then lastly, I think another area that we think such a core diversifier within global portfolios is alternative type of asset classes. So things like gold. Gold has provided great relief this year. It's rallied significantly, largely as a result of a risk-off environment. Central banks are starting to buy that asset class. So we've seen a nice rally in gold. And also just when there's political uncertainty, which we've seen, more and more political uncertainty globally, gold generally is a great diversifier for that particular reason. And then areas like infrastructure, private equity continue to provide interesting places to take advantage of. So those are where we, I suppose, diversify our risk exposure currently.
Thank you. So much to think about, and I think it's a huge advantage to have an investment team that sits in the UK looking at the international investments, and then a local team focused on the local investments, because you get focus, but so much overlap, and there's so much learnings between the two teams. I guess the next question that we should probably consider, Nats, is for the advisors who sit with clients trying to externalize their wealth. They always get asked, what rate is the right rate to take the money offshore? Now, we know currency traders can't even get the rate right. And then secondly, how much they should be taking offshore. Would you agree that the main reason for externalizing wealth is for diversification purposes or to protect against offshore inflation? Or are there other reasons that investors should be considering if they can't time the market in the exact time? Should they still be externalizing for other reasons in the portfolio?
Fluff, I think currency, more often than not, my conversations regarding offshores regarding currency. And of course, the currency is one important element to consider when externalizing assets offshore. But it's not the only consideration. The reality is the reason for taking money offshore is just because of the broad opportunity set that's available there, right? You know, different type of industries that are not available in South Africa. I mean, one glaring example is energy storage, as an example. But other type of asset managers that are not available here, different type of companies, sectors. The opportunity set is very broad, and different type of currencies as well. And that's a major reason for diversifications, as you alluded to, for taking money offshore. So going back to that currency point, I think currency is not just the only element to consider. I think you need to consider the reason, the rationale. What is your why? What is your why for taking money offshore? What need are you trying to fund in hard currency? And if you have a need, and a need in hard currency is generally needs to be funded over a long period of time. So when you're externalizing, rather have with your financial advisor, sit with your clients, have a well thought out externalization strategy where you can perhaps phase your assets into the market, not trying to time the currency, because as you alluded to, it's basically impossible, and rather slowly build up your exposure to global asset classes, which generally, as I said, provides a lot of benefits longer term. In terms of the why, you already alluded to it a few times here, is diversification, but I think also it's just holistically to reduce risk within portfolios. You hedge against the idiosyncratic risks of South Africa that we all very well acquainted with, but also just the volatile exchange rate that we have in South Africa. And then in terms of other needs that perhaps you're looking at, if guys are or clients are wanting to take money offshore, it's generally for travel, as you alluded to. I wish that was my rationale for taking money offshore. But another reason is more about funding children's education. Perhaps it's immigration, you're looking to relocate, and even just building, I suppose, wealth offshore for your future generations, generational wealth. There's many other reasons to take money offshore, and those are more longer term rationales, and timing the currency is not the only consideration there. More, as I said, the diversification and growth opportunities.
Thank you. I think it's a very interesting debate at the moment, because with the rand sitting where it is, as weak as it was last in, I think it was March 2020, we've also now starting to get a lot of advisors being asked questions by clients. Is this time, if the rand now strengthens from these levels, should we be repatriating wealth? And as you've heard, it depends on what the reasons are for taking that money offshore. We can't tell you exactly where the rand's going to go to from here and from these levels. What we can tell you is that over time, the rand has continued to depreciate, and from a diversification benefit, it's obviously a very important reason to have some of your wealth outside of South Africa. We've spoken quite a lot about how important it is for investors to remain invested, and just by missing 1 or 2 days in the market and not getting the effect of very good growth, and sometimes being out of the market when the market runs, or coming in and then experiencing a couple of bad days of growth, it's difficult. So as a portfolio manager, Ronnie, what advice would you give to investors how do you manage portfolios rather, to keep investors actually invested, make it easier for them to stomach some of that market volatility, so that they don't say it's gone down so much, I actually am going to exit and crystallize my loss? What are the considerations you think about from a portfolio management perspective?
Yeah, Flof, I think that's a difficult one. I think ultimately, it's basic human behavior. I think all investors sort of suffer from that natural behavioral biases and those blind spots that we all have at times. Perhaps where markets have run, a particular fund has done quite well, and there's almost that fear and greed element coming into it, in the sense of, okay, now I need to get into this fund, so I'm selling out of something else, or vice versa. Your fund has not done that well, and now you have the tendency to sort of sell it at the bottom. So I think first and foremost, what I believe is that it's very important to make sure that the investor is in the right fund from the get-go. So make sure that your risk expectations, in particular, are aligned to the fund and what the fund manager is ultimately trying to solve for in the mandate of that fund that it manages on a day-to-day basis. So that's the first point I would make. Second to that, I think this is where our strategic asset allocation is so important, because it really sets those risk boundaries around the fund in terms of what you can expect. And of course, those boundaries will be tested at times. And I think we saw that a good example was during sort of March 2020 in COVID. But ultimately, for investors who were able to stay with their conviction and stay in the funds, we saw very, very speedy and very strong recovery from those levels. So ultimately, it did pay to stay invested. Now, that's not always, I suppose, as easy as it sounds. But yeah, from our perspective, they say in investments, the only free lunch is really diversification. And I think our funds are very well diversified from a strategic asset allocation level, from a strategy level, and also from a mandate level. And ultimately, from our perspective, we try and make that journey as palatable as possible for the investors, so there are no real big surprises to the upside or the downside.
Okay, great. So when Rupert provides me with the stats on flows and switches every month, one of the things I notice is that unlike other networks, within the MFP book, there's no clear trend. But what I do notice is that there's still a lot of switching behavior, which means clients actually aren't staying invested. So they seem to be moving clients in and out of portfolios at almost exactly the wrong time, because there's always a lag to available information. Now, I suspect this isn't an advisor issue. It's driven by the client panicking or wanting a little bit, getting greedier. So Ian, how does that affect how you manage the portfolio when you've got this money moving in and out and it's not sticky money? Is it difficult then to allocate certain asset classes, or does it not affect how you think about it at all?
I mean, Flof, typically what we see in our portfolios is that clients usually sell out after the pain, and it's just a bit of portfolio experience that, once we see these clients exit, it's usually a very good contra-indicator that we at the top of the yield cycle is actually a good time to buy. But it's not a problem in terms of how we manage the portfolio, because we always keep a liquidity bucket, because if we think about our valuation methodology and philosophy, it means that to us, cash is always fighting power. And when these opportunities in markets arise, when the yields blow up or whatever, credit spreads blow up, that's when we want to buy, right? So we always have liquidity in the portfolios. But what it does mean is that, unfortunately, investors see, for example, long bond returns, and they say, I'd like to have that and those long returns. But the problem is they probably can't stand the volatility in the short to medium term. And then they exit and they crystallize the loss. So I think the one good answer here is, look, it's hard for us to try and time the market, but that's what we do. I think if you sit one layer or two layers away from the market, trying to time a fixed income market or yield curve is a guessing game at best, and you shouldn't attempt it. So the best advice I can give is, if you don't know where to allocate, and remember there's two levels of allocation on fixed income. It's always, the question is, in which asset class should I be? Is it bonds? Is it inflation bonds? Is it cash? Is it credit? Is it private credit? We get you into that space, but that's only level one. Level two is, okay, now we've chosen the bond curve. Is it the 2-year point, the 5-year point, or the 30-year point? I mean, it's very hard to do those things. That's why we've got a whole team and a whole process. So if you can't do that, rather go into a multi-asset fixed income fund, which does it for you. You get the best view of the team. This point on the 10-year, on the government curve, that point on the credit curve, that point on the money market curve. And I think over time, the ride will be a little bit smoother, and you'll probably get a very similar outcome than you would get in a pure duration ride. So I think rather go multi-asset fixed income than just taking a binary bet on one particular curve, because the volatility may hurt you over time.
Phew, that's a lot to think about. I'm glad I'm not the person having to worry about making those decisions. MFP advisors have a choice between the MFP focus model portfolios and the momentum focus fund of funds. Dean, what are the differences between the two ranges, and what factors should advisors consider in deciding which is more important or more appropriate for their client? We've already heard from Ronnie earlier that the two are aligned, you have the same outcomes, same investment horizon. So how do we make it simple for advisors to decide which is most appropriate for their clients?
Yes, I think, I'm going to start with what they shouldn't be doing, and that's coming back to your point, is that Ronnie and I manage these solutions very closely from an investment perspective. So advisors certainly shouldn't be trying to pick the vehicle which they think is going to perform better over the longer term, because the reality is that we manage these in such a way that the performance over the long term should be practically identical. Yes, there may be short-term deviations depending on the different mandates that we have access to within the different vehicles, but for the most part, the investment performance will be very similar. So the choice then becomes more from operational constraints and understanding the differences from an operational perspective between the two vehicles. And the most obvious one is the wrapper that they sit in. So the fund of funds are a registered CIS vehicle, which means that as an investor, you will invest into that fund, and the fund itself will then invest into underlying mandates, whereas a model portfolio is more an operational tool that is offered by the Momentum Wealth platform to give investors access to a range of underlying funds managed by professional investors like ourselves. And there are different consequences to those vehicles. So starting on the model portfolio side, one of the perceived advantages on the model portfolios is somewhat increased transparency. So as an investor, because you go into each underlying fund in your own right, when you get your statement at the end of the quarter, you will see exactly which fund sits within those solutions, whereas on a fund of fund, you'd obviously be in that fund alone, and therefore you'd only see one fund. Having said that, we try to get around that or mitigate that for the fund of funds by including all the mandates on something like the fact sheet, and we even go as far as for certain mandates where we might buy an internal unit trust that's managed externally. On the fact sheets, we'll further add that this fund, although it's called something like Momentum Macro Growth, that it's actually managed by a Blue Alpha or a Fairtree. So we try to provide transparency in that regard. A secondary thing for the model portfolio is that because it is not a registered vehicle, there is the potential for slightly cheaper costs that come through there, because you don't have to pay audit fees, manco fees, etc. But again, we mitigate this by ensuring that the mandates that we get access to in something like the fund of funds, we negotiate very hard with with external asset managers to ensure that the fee experience between the two solutions again should be fairly negligible. So we don't want to penalize any investors depending on which vehicle they choose from a fee perspective. And I think more importantly to that, irrespective of the fees, we always try to achieve the results on a net of fee basis, and so clients should in no way be penalized by the fees that we pay. We'll try to offset those as far as possible. And then if we move to the CIS side, I think one of the biggest advantages from a fund of fund perspective is obviously capital gains tax. So as Ronnie mentioned, we do make tactical calls, and it is quite regular, and perhaps more regular in markets that we find ourselves in now, where things are moving on a daily basis, and you want to be a bit more nimble and make changes quite frequently. And one of the drawbacks of model portfolios is that when we do trigger a rebalance or a trade, that may create a CGT liability in the hands of the investor, whereas within the CIS, that only happens when the investor himself chooses to sell the unit trust. Having said that, we do try and mitigate that by making more frequent smaller trades to lessen the impact of CGT, and of course by making those smaller trades, you do get to harvest any sort of capital losses over time. So you reset your purchase price every time you make a trade, which somewhat over time mitigates the large CGT liability. And then perhaps the final one in case of the fund of funds is a slightly bigger investment universe. So from a model portfolio perspective, we really are constrained to what's available on the list platforms, and particularly the local platform. Whereas in the case of Ronnie's fund, and I'll use a very good example, something like the Momentum Global Fixed Income Fund, which is a specialized fund run by the MGen team, very credible fixed income fund, but is unfortunately only available in a hard currency solution. And so in something like the fund of funds, we can access it directly by going offshore, whereas on the local side, we'd have to find an appropriate substitute that is accessible through something like a feeder fund. And so on the model side, we try to get around this by making sure we find appropriate substitutes, and where the investment case is very strong, we'll go about launching something or pushing for a feeder fund, such as the Momentum Sustainable Equity Fund that will be making its way into the portfolios very shortly. The feeder fund is now becoming available, and so we'll push to get access to those. So maybe to conclude, I think there's no right answer in terms of which vehicle is most appropriate. Given the advantages between the different solutions that I've just gone through, I think it's very important for an advisor to understand those, explain it to the investor, and then find out which is most appropriate for their specific circumstances.
Okay, thank you. So from an advisor perspective, if they're concerned about CGT, I guess you'd put it through the CGT calculator on the platform and work it out. But in my experience, actually, often advisors and clients are worried about the tax payable, but once they put it through the calculator, it actually often lands up that there actually isn't any tax payable, and if it is minimized for all the reasons you explained. Nats, you went into quite a lot of detail earlier about the reasons to take your money offshore. So I think we've covered that quite substantially. But what I'd like to hear from you is, when you think about portfolio construction in the offshore sense, is it different for the offshore portion of local portfolios versus your hard currency portfolios for clients who've already externalized their wealth? And if so, why are there differences if the same team is managing both?
So, Fluff, so then you're talking about the feeder funds versus the direct hard currency portfolios. So I think, again, it's regarding your different needs, right? So if you're wanting to externalize assets offshore, it's because you've got a long-term goal to fund. So being, I already alluded to it, education, perhaps immigration, intergenerational wealth down the line, overseas holidays. But when it's the feeder funds, a great benefit of a feeder fund is the fact that they're lower minimums. It's an easy way to get consistent exposure, I suppose, to offshore markets when you don't have the sizable amount of assets to actually externalize. And also, you know, if you've got to fund your South African needs, so your South African liabilities, then, you know, maybe a feeder fund is perhaps a more suitable vehicle to use in that type of investment space. And of course, anyway, within the MFP solutions, whether it be the models or the funds, you're already getting exposure to a lot of feeder funds through their offshore allocations. So they'll be able to ensure that the allocation to feeder funds that is necessary to fund a specific outcome in RAND terms is weighted appropriate given the economic environment, the asset classes available in South Africa and globally, et cetera, et cetera. So I think big picture, it depends on the need always. Investment minimums and investment time horizons always and fundamentally.
Thank you. Thanks to all of you for your time today and sharing all your valuable insights. As an advisor, the most important things to remember are to ensure that the portfolios you select speak to your advice process. The MFP Houseview range of portfolios has been designed to do exactly that. It allows you to have discussions with your clients around their short, medium, and longer term requirements, their risk tolerance, as well as what they are saving for. So stick to the basics, determine what falls into each of the horizons, the investment outcome that your clients are looking for. They might have multiple outcomes. And then spend some time explaining the expected maximum and downside risk over the rolling 1 year periods, for example. As Ronnie mentioned earlier, in the more conservative portfolio, they're designed to not lose any capital over rolling 12-month periods, whereas the more aggressive portfolios can lose up to 10% in any year. And we're comfortable with that because you have the luxury of time to make that negative up. Once the client's comfortable with the portfolios they've selected, keep reminding them why they selected these and stick to that plan. Changes from one portfolio to another should be avoided unless the client's circumstances have changed. So either the time horizon has moved out or become shorter and they need the money, or they're looking for a lower return, or they can't stomach the risk. That would be a reason to change portfolios. But once they're in, try and keep them invested. The partnership between MFP, Momentum Investments, and Equilibrium is a strong one. We rely on you as advisors to let us know what is that your clients are battling with, so we can then design and manage portfolios to address those requirements. We trust you to give the best advice, and we know that you trust us to manage the portfolios to the best of our ability. We are an extension of your MFP practice. Thank you for the support. We've no doubt that together we'll continue to build real wealth for all our combined clients.
Thank you to everyone on the panel. I just want to sum up today's conversation and tie it back to the MFP advice process. Today we heard from Sanisha that uncertainty in the global economy will persist for a while longer. She spoke about the 10 known unknowns that is present and poses various challenges. The takeaway from her is that the future is still very much uncertain and that we need to brace ourselves for various potential outcomes. The question thus is, how we do this for our clients? The answer from our panel was consistent. Start with what the investment outcome is for your client. The foundation of sound investment advice is aligning your client's goal with the correct solution. Ronnie discussed that asset allocation is still the most important factor in achieving a stated outcome, and if a client's portfolio is not positioned correctly, achieving their goals become a lot harder, if not impossible. Market behavior is also out of our control, even if we get our asset allocation spot on. If markets don't deliver the returns that we need, we must adjust our expectation of what is achievable accordingly. As mentioned by both Ronnie and Dean, they are actively looking within their long-term strategic asset allocation for various opportunities and will make tactical adjustments to benefit our multi-asset class solutions when the opportunities present themselves. This is evident with their prudent increase in offshore allocation when the changes to Regulation 28 was announced. The panel made a strong case for diversification, which is a key component in constructing client portfolios. It is, however, very important to filter out the short-term noise and stick to a sound portfolio construction process when putting together and managing your clients' portfolios. As Natalie pointed out, offshore markets have done very well year to date. However, this was not the case last year where local asset classes outperformed global. The point once again being that diversification is crucial. The offshore market poses many benefits for clients as the opportunity set is much broader than we have locally, and it can serve as a currency hedge. But always remember that offshore investing should be done to address specific needs within context of clients' overall investment objectives and to diversify client portfolios. The diversification can be achieved in two ways: exposing client funds to local multi-asset class solutions such as the MFP model portfolios, the focus fund of funds, or the momentum feeder funds. Alternatively, client funds can be externalized by applying for a tax clearance and investing in hard currency offshore solutions such as MGIM solutions. With the current level of uncertainty globally, it is easy to lose perspective, and there's a lot to be downbeat about in South Africa. You can take your pick from load shedding, political uncertainty, poor economic growth, and the collapse of many state-owned enterprises, to name a few. While you can't wish away the steady stream of bad news, what you can do is remain objective and avoid getting emotional with your investment advice. Markets will always be unpredictable and we will never be able to control it. What we can control is how we react. It's imperative for your clients to understand what is needed for them to achieve their investment goals, which starts with staying invested in the correct solutions, and for you as advisors to keep them on track. What we can do is ensure we build robust solutions that you can use when constructing your clients' portfolios and support you with the latest updates available. The MFP Houseview caters for all client needs across the risk spectrum, and I urge you to please engage with us where you have any uncertainty around the solutions. The latest MFP Houseview newsletter is available along with the quarterly review clips done by the Equilibrium and Momentum Collective Investments team, and that's available on the MFP Investments Connect site. This will go a long way in assisting you with the necessary information to share with your clients during your engagements. Your true value lies in the ability to build trust, confidence, and financial peace of mind for your clients. Partnering with a provider whose solutions are constructed with your clients in mind, and hopefully by using the insights gathered today, will help anticipate your clients' needs and help them achieve their investment goals. Finally, I would like to welcome MFP M-Channel Director, Francois de Raval, to close the event for us.
Greetings and good day, dear colleagues. On behalf of Momentum Financial Planning, it is my honor to close the session today. But before I close the session officially, I would like to mention three specific aspects I picked up of today's meeting. So basically, the first one, Hugo mentioned the growth and adoption of tech. I cannot stress that enough. With the volumes of work, with the changes, legislative changes, product changes, training, all the requirements that we have, it is absolutely imperative for us to use tech and get adoption. As individuals, we could simply not cope with this. So please, you can see myself, I'm getting in the pensioner age. Tech is as difficult for me to adopt as anybody else, but I ask you for a special favor to spend some time and effort into the adoption of the tech that we are developing currently for you. Secondly, Rupert, any session, gave us 6 compelling reasons why the MFP Houseview portfolios. Permit me to add one more. It is for your protection. What I mean by this, there is an expert panel that sits on this. We make all the decisions and we know that it will pass any test with any kind of complaint or whatever a client could give. It is prudent, it is responsible, and it is well structured. And as mentioned in the session, it is delivering on expectations. Lastly, during the panel conversation, Fluff and Ian's session more specifically, we talked about the timing and the move of certain clients to fixed income. Well, let's be honest. I'll be the first one to stand up and say, I'm one of these. I had to run to fixed income just for my own safety, security, and peace of mind. You might disagree with me. That is for me personally as a client and somebody who's about to retire soon in the next year or two. But the most important lesson in that is the timing in. I did not switch. All I did is do some future contributions to have a little bit of waiting in fixed income to try my best to stabilize the yo-yo effect we are having at the moment. So, as I said, I'm sure that all of you would have picked up some pearls of wisdom in this session. And all I can do now is to thank you once again for your attendance and goodbye until the next time on behalf of Momentum Financial Planning and Momentum Investments. Have a great day.
Thank you, Francois. From my side, thank you for attending today's MFP Outcome Matters. I trust that you have found the content not only interesting, but also insightful, and that you leave here today with valuable information to discuss with your clients. Just a reminder to watch the full session and add your ID to the CPD section so we can verify your attendance, and that our event platform will remain open until the end of June for you to still view this event and still receive your CPD points. Until next time, goodbye.